Good afternoon and welcome to another edition of Unlock the Stock. This Unlock the Stock platform, as you know by now, is specifically designed for retail investors to gain access to corporate management, to get to know them and their companies just a little bit better. We are very pleased to welcome back for the fifth appearance on Unlock the Stock, CA&S. Duncan Lewis, the CEO, and Frans Rech, the CFO, will join us today, and Duncan will take you through a presentation shortly. Unlock the Stock is only possible with our technology partners, Lumi Global. Please visit their website at lumiglobal.com to learn more about Lumi's various online AGM and investor presentation solutions. As usual, our hosts today will be the Finance Ghost and Mark Tobin from Coffee Microcaps, and they will be facilitating the Q&A session. Before we start, there are just a few housekeeping notes. Duncan will take you through a presentation, and this will be followed by a Q&A session. You can post your questions by typing them into the Q&A box, which is at the bottom of your screen. The event is being recorded and will be available on our Unlock the Stock YouTube channel later in the week. You will see an email address when we start the Q&A. If you want to be placed on the CA&S contact database, please jot down that email address and send them an email with your details, and they will put you onto that address list. Duncan, I think we are ready for you. So I'm going to hand you over to start your presentation and take us through these exciting results.
Thank you, ma'am. Good afternoon, everybody. And as always, thank you for your ongoing interest in our business. It's a great pleasure to be with you. Just a little bit about what we're going to do. For those that are new to the platform, I'm going to just cover a little bit about who we are, what we do and why, and then obviously an update on the half-year results, and then a deeper dive into the segmental, and then I'm going to hand over to my colleague Frans Rech to go through some of the financials, and then an update on our outlook and journey towards 2026. And then, as Deborah said, some questions, and I hope to get through this in the next 30 minutes. So thank you very much. Next, please, Andre. So as I said, a little bit about who we are and what we do. Essentially, we represent brand owners of consumer packaged goods. Our job is to ensure that we execute their brand strategies at the point of purchase. And from a shopper and consumer point of view, we want to make sure that you have on-shelf availability and that you have access to your shoppers, access to the brands that you have become accustomed to and familiar with. And we do this in South Africa, but also in the BL&S territories, which is Botswana, Lesotho, Namibia, and what was previously known as Swaziland, now Eswatini, and up into East Africa. Next, please, Andre. Just a little bit about our services. So we have 4 pillars that we use to execute, and that is warehousing and distribution, retail execution and advisory, retail support and training, and then lastly, technology and data solutions. Next, please, Andre. If I talk specifically around warehousing and distribution, we have fairly big physical infrastructures in the territories outside of South Africa, which is where we provide what I would describe as a full service offering for brand owners. So we would have big physical infrastructures, big warehouses. We would have vehicles on the road and lots of feet on the ground. So lots of people that we employ to deliver these services. Next, Andre. On the retail execution and advisory, what that means is of the 15,300 people that we employ, for the most part, these people are employed in these retail environments, And the retail environments would be retail, wholesale, forecourts, quick service restaurants, etc., etc. And our job is to receive the stock when the time it comes at the receiving bays or the back door, and to take it to the shelf. But also, our job in these retail environments is to make sure that we execute promotions, that we inform shoppers and consumers around new product developments, innovation, etc., etc. Next, Andre. If we talk about retail support, the nature of retail has grown in complexity, and shoppers and consumer demands are rapidly evolving. So what we do for the brand owner, we also execute promotions, and we would have large point of sale and in-store execution teams. So what we would do is we would erect gondola ends. We would look after what we would describe as the snake aisles, which would encourage impulse purchase, create awareness, and make sure that we are maximizing the high traffic areas in a store, or the so-called hot zones. If I can ask you to go to the next slide, please, Andre. If you talk about technology and data, I look at this through two lenses. One is internal, and we have a very well-established mobile technology solution, and that is how we are managing our resource in store. So it's how we communicate with our 15,000 people, but also it's how we push tasks to 15,000 people, and we are managing their workload. We are managing the communication to them, and from them to ourselves and to our customers, and giving our clients evidence of executions that have taken place in store, whether it's around pricing, competitor activity, or giving them evidence of new product development being in store, being sold, etc., etc. The platform that we use is geocoded, so we know exactly when I need to be in store. I know what tasks I need to perform. I know how long those tasks take, and where I haven't been able to execute those tasks, we have reasons why, and that is escalated through the system, and actions put in place to remedy that. Next, please, Andre. If you take our clients, we're very fortunate to represent the top 200 or 220 consumer brands in the world. Our clients would either be number one or number two in the categories in which they compete. The average client has been with us for 18 years, and many of the clients going back for over 4 decades. These clients have very high standards. They're very demanding, but I think that their demanding and high standards, I guess, makes us a better business. And I think that we're very privileged to represent these brands in the markets that we serve. Next. You heard me talk about the 4 pillars or service pillars in the organization. Here you can see the businesses that execute those tasks and in the geographies. So if I look at the top left-hand corner, you'll see Wito Trading, and they're in Namibia, and you'll also see them in retail execution and advisory. So obviously, they provide those 2 generic services. If you look at the bottom tile, you'll see the CA&S Group. They are exclusively in the retail execution and advisory, retail support in the technology space, because we don't do the walls, wheels distribution side. Next, Andre. If you look at these geographies, these are the 8 geographies where we have our resource deployed and where we represent these clients in the various retail environments. However, if you look at Mac Mobile is our mobile technology solution, and they perform services for the carbonated soft drinks market, for the alcoholic beverages market, where we manage their sales force, we manage the cash sale environment, and they're in a further 16 countries in Africa. Next, please, Andre. I often get asked is, how do we identify markets we want to serve? I think that we have what we would describe as priority markets. So our priority markets would be South Africa and the BL&E territories I referred to earlier, but also we have targeted expansion into East Africa. I think the question becomes why, and that is by and large because we have a client-led growth strategy. It's our clients that want us to provide them credible services in these geographies. From our perspective is that we look at what is the potential in these markets. And so, we would look at things, for example, like GDP growth. We would look at things like what does urbanization look like? How is modern trade in the current environment? Is modern trade main market mix going to change over time? And if you look at these markets, they have, generally speaking, rapid urbanization. They have a rapidly growing middle class. They have a relatively high degree of economic certainty, a strong treasury, and it's based on those factors that we would choose priority markets. Next, please, Andre. Another opportunity that we've identified is the main market, and the main market in South Africa specifically. Our clients that we service are very well established in retail, wholesale, convenience channels, but increasingly they believe that there is an opportunity in the main market. And just to be clear, we're talking about the retail environment below wholesale, and particularly in the townships where, I think that based on the research, I think is significantly bigger than people initially thought. And, based on what we have been able, based on the research we've done, had access to, it's worth over 180 billion rand annually, which represents probably 25% of the total market. So our clients are underrepresented there, and we've been looking for solutions to provide them in this market. Next, Andre. So what we did in the 1st of April of this year, we bought a 49% share in a business called Roots. Roots have been active in these channels for over a decade. They service over 12,000 retail outlets and have a very good solution to provide brand owners. And our intention is to use this DNA and framework and learnings and to expand the offering to existing clients, all of whom have an appetite to expand in this space. Next. East Africa, the priority markets that we've identified in East Africa, we're already in Zambia, but the other markets we've identified is Kenya, Tanzania, and Uganda. And, I think that you heard me talk about the reasons why we have a rapidly growing modern trade. We have got the urbanization that I referred to, et cetera, but also we have positive economic growth. Whilst we have the business in Zambia and have been there for close to 2 decades, our strategy is to grow through acquisition in East Africa, and our model, generally speaking, is to buy a minority stake in a business, at least 35% in a local business. The businesses we try and target are owner-operator businesses that are from that geography, that understand the landscape, businesses that have a history of making profits, but more importantly, a business that is like-minded, has a similar value system, and has an appetite for accelerated growth, and to be part of a broader ecosystem where we can bring our learnings to them and we can take advantage of the momentum they got, but also their local knowledge. Next, Andre. I think that the only thing that I want to highlight on the slide is around stuff that has served us well, and that is having deep knowledge of these markets. So I think that if you look at the clients I referred to earlier, and the average client having been with us for 18 years, we understand the categories in which we participate very well, but we also understand the brand's role in a particular category, and we know what we need to do and implement for the client to win in a particular channel or retail environment and geography. So if we combine that knowledge that we have with the knowledge of the local market and the momentum that the local operator has, we believe that that together is a catalyst for accelerated growth and the catalyst for increased new business for our client and for ourselves, of course. Next, Andre. The only thing around our business model I want to talk about here is that we do not make a margin on stock. We make a margin on the services we provide. So it is the brand owner together with the retailer that determine the retail selling price. And we make we charge a fee for the services we provide. In other words, the combination of the warehousing, distribution, in-store execution, et al. We'll charge a fee for that and make a margin on the fee that we provide. Next. It's interesting. So, if we look at the year-to-date June results, which we'll get to just now, certainly in Q1 and Q2, the narrative was around the cost of money. The narrative was around food inflation, load shedding, et cetera, et cetera. If we fast forward to, if I can call it post the South African elections, and we start talking about July and August, is that, specifically food inflation. Food inflation in November and December last year was double digit. And if memory serves me correctly, is that food inflation peaked at 11.7% in December last year. Food inflation on a year-to-date basis is
below
5%. We have had probably close to 150 days of no load shedding in South Africa. We're hearing talk of interest rate cuts. And so the narrative has evolved quite rapidly. And interestingly enough, is if we look at our business on a year-to-date July basis, we are getting volume growth. And so the average volume growth across our businesses, jurisdictions, et cetera, is 3.5%, which is very significant. So, I think that the mood music has certainly changed, and we are feeling more and more optimistic about consumers and shoppers having more disposable income over time. Thank you, Andre. I think that our business has been based on three cornerstones, if I can call it that. One is what I would describe as capability building. And so, I guess the right people equipped with the right skills and tools to do their job. We're also very intentional about growing people through the organization and growing our own timber. And we try and let people have careers through the organization. And so when we are recruiting, can the individual perform at 2 or 3 levels higher than the job that they're applying for? Do they have learning ability? And I think that for us has been very important because it results in significantly lower staff turnover, but also it creates an emotional bond between the people, our business, and the brands we represent, and that has served us well. The other thing is around operational efficiency. I think that we operate in a high volume, low value environment. So it's really important that we are efficient as an organization. And so we've invested heavily in technology that results in, I guess, improved efficiencies and operational execution. So if you look at our inventory management system, our transport management system, and warehouse management system, combined with how we manage our workforce, you'll see on a year-to-date June basis that we're more efficient. Our overheads are lower, in this time than they were this time last year. So I think the point we're making is that we're striving for continuous improvement. And so our view is that if we got the right people equipped with the right skills and we are executing efficiently and effectively, our accelerated growth ambitions will come as a consequence of that. Thank you, Andre. We're very intentional about evolving our revenue split. So, if you look at warehousing and distribution, when I first started on this platform, it was a 85-15 split from a revenue contribution. So just to be clear, warehousing and distribution was 85% of our revenue, 15% was from the other. If you look at for the half year June, it's roughly 81-19 split. We want to ensure that we expand the other services, and the other services allow us to provide clients with greater value. It's also margin richer, but I think that over time that creates a competitive advantage. So our intention is over the next 24-36 months is to evolve it from a 70-30 split from a revenue contribution point of view. And, that is potentially brings the revenue and the profit contribution to a 50-50 split. Thank you, Andre. Next, please. I'm going to talk specifically around the half-year results. So if you look at the tile here, we're talking around revenue. Revenue grew for the half year by 9.2% to 5.728 billion. If I break that down, you'll see that 8.6 of the 9.2% was organic growth, and only 0.6% of it was acquisitive growth, and that was as a result of the transaction we did in South Africa, MarketMax. If we look at the organic growth, the new business contributed 4.7 of the 8.6, and then price increases 2.5%, and then the volume increase was 1.4%. If you look at the operating profit operating profit declined by 21.1% to 305 million. I think that what's important to mention and remind the audience that are new to the platform and may not have remembered, on the 1st of January last year, we did the acquisition of the Tobin business in Namibia, which was the Bidvest-owned business, and we got a so-called gain on bargain purchase of 123.5 million, which we didn't have in the half year for this year. But if I strip that out or exclude that, our operating profit increased by 15.9%, just that you're aware of it. If you look at the earnings per share as a consequence was 43.9 cents, which is a decline of 30.7%. And then if I go to the adjusted EBITDA, that's up by 14.4% or 358 million. The headline earnings per share up 19.2%. And then lastly, the net asset value per share up 14.7%. Next, Andre. Just on the operating profit, I think this really just unpacks it. I have my colleague Frans next to me. I'm not sure if there's any specific you want to talk about this, Frans, but what I will say is that, I think the operating profit, as I said, increased by 15.9%. And excuse me.
Thanks, Duncan. So,
excuse me, guys.
Thanks, Duncan. I think Duncan have elaborated on this. I've got a thing that I wanted to say that we had a lecturer that said you can torture the heart until it confesses. Now, this is one of those typical things that you have to take out something to compare apples with apples, and this 123.6 million relates to that Tobin transaction, which Duncan has mentioned. And if you take that to just compare where we're going and see if the business is growing and normalize it, it shows that the business is still growing very healthy at 15.9% on the operating profit line. Thanks, Duncan.
Is that it? Thank you. Next, please, Andre. I'm sorry. Next, please. What I wanted to just share with you is the segmental and the growth by geography. So, very simply is that Botswana continues to grow. It's the biggest contributor to our total business. That grew by 8% for the half year to 2.852 billion. Eswatini growing by 10.7% to 840. Namibia, according to this, has declined by 2.5%. But in real terms, it's grown by 5.5%. I think that, again, this is as a result of the Tobin transaction. In Q1 and Q2 of 2023, we provided services for clients in the ambient, chilled, and frozen space. We don't see chilled as core to our business, and so we exited many client contracts in the chilled space and transitioned them to other service providers, ensuring that they had a soft landing and continuity. And so, some of it was intentional. The other business that we resigned was because of conflicting brands, where we represent brand owner A, and the TNC business represented brand owner B. And, it's just not palatable for either party, so we had to resign some of that business. If you take South Africa growing by over 20% to 874 million. That's as a result of new business signed on new clients in late 2023. And we are growing our new business pipeline, and we expect that to continue. and all the other countries, and would include Lesotho, Zimbabwe, and Zambia, off a small base, but growing at over 60%. Andre? I'm going to hand over to France just to talk through some of the financials before I come back.
Thank you, Duncan. Yeah, I'm just going to spend the next few minutes going through the primary financials. If we look at this graph, I mean, Duncan already mentioned all these abnormalities on this, specifically with the revenue growth of 9.2%, but doesn't flow through on the profit, operating profit that declined with 19 point, headline earnings. We are one graph too early here. Sorry, guys. This is a headline earnings per share graph. The revenue growth of 9.2%, Duncan has unpacked for us with the 8.6% organic growth and a 4.6% of acquisitive growth, which relates to the market max transaction. Headline earnings per share, it grew with 19.2%, which is a nice growth, which is a result of the positive revenue growth, the cost containment, the positive contribution of our associates, the new associate, the Roots, and other associates in Zimbabwe. And of course, also with the stronger rand to the pula for this last 6 months, and the cash management of the proper cash management and the interest that we utilized through that. On the next slide, please. If I look at our income statement, nice revenue growth of 5.7 billion from 5.245 billion. The adjusted EBITDA, nice growth on that to 357.9 million, which is also attributable to the positive revenue growth, cost containments, associates contribution, and the stronger rand to the pula. If you go to the next slide, Andre. If I look on the balance sheet, the current assets has increased of 10.5%. That relates to the acquisition of Roots, the increase in the warehouse capacity in these different regions. That's not just CapEx increase needs. It relates to the IFRS 16 accounting that we had to recognize a right of use of asset. And then if you look at our current liabilities, I'm pleased to show that there's a decrease of 8.6%, mainly related to repayment of some of our overdraft facilities in the different regions. If I look at our current assets and current liabilities, working capital is still making up the biggest items on our balance sheet. Current assets is made up inventory 26%, trade and other receivables 45%, and cash making up the 28%. If you look at our current liabilities, making 63% is our trade and other payables, and 27% relates to borrowings. If we move to the next slide, please, Andre. This is more detail on the working capital levels. As you can see, the net working capital days is in line with the previous 6 months, 33 days. But this is also this slide is indication of our cycle seasonalities. We will move into our peak season in the next 6 months, which will require more investment in working capital, and our working days will increase. Working capital is still our major core function that we need to make sure that we manage it properly and to have a healthy business. If you move to the next slide, which is our cash flow, you'll see that working capital we have a positive working capital inflow of 225 million for the first 6 months compared to previous 6 months. And that all generated to a positive cash generation from operations. If you look at tax, we have the tax includes some dividend withholding taxes that we had to pay for dividends extracted out of the different regions. And that increase is once-off tax, it's not normal taxes, but that also shows that if we pay taxes, we are profitable, we are generating profits, and it's a positive contribution to the different segments that we operate in Africa and Southern Africa. The net interest of 14.6 million is just the outcome of our cash management. And then if you look at net investments, that's our capital. We allocated some capital to the acquisition of Roots, which Duncan has mentioned earlier. From the 1st of April, we paid that, and they are it's part of our channel broadening strategy, and they operate in the informal market, or the main market as we know it. CapEx expenditure was done in accordance to our normal capital replacement policies, and a few additional additions to motor vehicles, mainly in the regions where we have some growth and needed more capacity. Well, not included in this slide is our investment in capability building through making our operations more efficient through the utilization of information technology. And we have paid a dividend of 92 million on the 1st of April this year to our shareholders. And looking at these numbers, I think we are very optimistic that we will be able to achieve our strategy to grow, and our ambition to achieve the 20 billion in the next few years. Thank you very much, Duncan.
Thank you, Frans. Andre, I'm mindful of time, but if you, I'm just going to talk very briefly about ESG. So would you mind fast forwarding, please? Next. I think ESG has become increasingly important, and I shared with you who our clients are. You know, I think that our clients hold us to a high standard. And I think that we hold ourselves to a high standard, and that means we need to be responsible citizens in every sense of the word. So I'm not going to take you through all the detail, but what I will say is that we have prioritized certain things. And so 2 years ago, we have developed a framework and a benchmarking for progress and success. So I think that certainly on the environmental side, we have prioritized energy and our carbon footprint, in making sure that we have a transition towards renewables. We started that journey with a solar project in our Eswatini operation, which in its first year supplied 70% of our daytime capacity, which we are expanding. We've done it in our South African operation, where 100% of our needs are taken care of through renewables, and we're expanding that to our other territories, including Botswana. From a human capital point of view, you know, I think that you heard me talk about our investment in people, growing our own timber, etc., etc. But also, I think that from a community standpoint, is that we support over 50 charities. We have prioritized education. And by way of example, in Eswatini, we sponsor 5 schools where we provide not only the meals before school, we provide the teachers, we provide for the teachers' ongoing development, we provide for a meal before the kids go home. And, you know, I think I'm very pleased and proud that we can, I guess, make a positive contribution in that geography, and similar projects are underway in all our geographies. If one just fast forward, if you don't mind, 2 slides, Andre. The last thing I want to mention is just around the governance. Obviously, because we listed, we have a tight governance framework that is evolving rapidly. But, I think that our teams are evolving in skills and capability to remain remain future fit and relevant. Just on the update towards 2026, Andre, next please, sir. We remain committed to our accelerated growth ambition of creating a 20 billion rand business. That was a combination of organic and acquisitive growth. I get asked about this all the time. I think that organic growth, we're on track to be a 18 or a 19 billion rand business. And the shortfall of 1 billion is through acquisitions, through other new services, complementary offerings. But I think that this is what keeps me, I guess, hungry, what keeps the team uncomfortable. But the revenue growth is simply a proxy for sustainable, profitable growth. I think that, our egos are not that big that we are going to be silly and short-sighted about ensuring we achieve the dream. If we end at 19 billion and have a sustainable, profitable business, well, I guess we will be comfortable with that. Next, please, Andre. I think, very simply, our objective is to grow in existing geographies with, I guess, existing clients, and, the opportunities to grow with existing clients in existing geographies remains the single biggest opportunity. We still have lots of channel broadening opportunities, one of which was the main market I alluded to earlier. We have identified East Africa as an area of expansion for the reasons I mentioned. We're actively working on those and have processes in place to bring something across the line. And, when appropriate, we will share the detail with you. Thank you, Andre. I think that, the only thing that I think is probably worth expanding on here is that we have a very good senior leadership team. The senior leadership team are significant shareholders and stakeholders in the organization, and we are committed to sharing best practice across the group, whether it's in areas of operations or technology. I think that the team is, I guess, hungry to make a meaningful impact in the geographies that we service, and believe in the potential of the organization. Thank you, Andre. Andre, I'm going to leave it there, and I think that just in the interest of time, I want to hand over to your audience and take as many questions as possible.
Thank you, Duncan, France. I'm going to jump straight in because obviously we don't have a ton of time left and we've got some cool questions to get through. I've got some in my DMs that I certainly want to get to as well.
Yes,
I'm going to kick us off. And I think you referenced earlier that in terms of your pricing model, you pretty much set a fee based on the value of the goods flowing through the system on your side, and away you go, which suggests you are nice and positively exposed to inflation, which is a good thing. You're not exposed to the margin that the retailer, or sorry, the FMCG group is actually making on what they are selling. What is interesting about that, though, is what does that mean in terms of the categories that you can participate in? Do you find that it's generally higher margin categories that flow through you because the FMCG provider has the sort of space to let you in? Or just any commentary on what it means in terms of the kind of products you generally are servicing. Is it linked to the underlying margins?
Yeah, so I mean, some categories have higher margins than others, and the lower margin categories often have the velocity, the stock turnover that we need for the business and to give us scale. So, we would do commodities like white rice, wheat and maize, etc., oil. But we'd also do, high-end personal care products where, you're spending 400 or 500 rand on a 50 milliliter unit. So it's the mix in the geography that gives us, I guess, both the scale and the margin. So I hope that answers your question, sir.
Yeah, it does. So it's nice and across the board. Thank you. Over to you, Mark.
Duncan, just one from me and maybe for Franz as well. You know, we're kind of at you referenced in the presentation, you know, hopefully at the kind of peak of the interest rate cycle, and, you know, let's say next 12, 18 months, let's hope they're on the way down. But to just give us some historical context, because you haven't kind of been listed that long, does the business generally get a kind of a free kick from these interest rates falling, in terms of, you know, it flows through into consumer spending, you know, you see more volumes coming through, and it's a win for your business? You know, I think you and Franz have been around CA&S for a long time, and you've been in the industry a long time. You know, exclude COVID because that's kind of an outlier, but generally in a falling interest rate environment or a lower interest rate environment, what's been the kind of historical experience?
Yeah, so, you know, I think that, you know, the opposite of that is that in an inflationary environment, if we're able to manage the costs, we are net beneficiaries. And there's no doubt that there have been periods where we've been net beneficiaries of inflation. But I always worry about the sustainability of that. So the real measure of growth for me is on volumes. So are we getting volume growths in our categories? And as I said, for the half year, you see volume growth was 1.4%, which is not bad. But if you look at it year to date, July, an average of 3.5%. So I think the point I'm making is that the real sustainability of a consumer and a shopper that has disposable income is really the mix that we sell. But I look very closely at volume growth, and I'm very pleased that we're getting volume growth across all our geographies and across all our businesses.
Thank you.
I've got a pretty important one in my DMs that I think is worth bringing into the conversation, which is just around the long-term impact on Botswana if mined diamonds continue to have an issue. Now, obviously, you guys are not in the diamond market, but you are exposed to that market. Do you have any kind of plans to maybe, you know, take some of your business to change the geographical mix ultimately, or do you feel as though where you are currently, other than some bolt-ons, is pretty much okay? And to be fair, the question also points out, you know, there are some recent oil finds that might boost the Namibian economy, for example. It's all guesswork, of course, where these countries might go over the next 10 years. But any views you might have on some of those exposures?
You know, I think, you know, notwithstanding the comment specifically around diamonds, you know, if you think 10 years ago, 100% of our business was Botswana. Is that, you know, for the half year to 50-50. So, you know, I cannot talk about sustainability without looking at risk mitigation, whether it's on a particular client or a particular geography. And we've been very intentional around creating sustainable businesses in other geographies, to provide our clients with a regional solution, but also to ensure that we have a more balanced business. And so, you know, I think that notwithstanding that, I still see Botswana as an invest to grow market. And you'll see that Franz spoke about the CapEx. We increased our warehousing capacity in Botswana, and we'll continue to do that where appropriate. So, you know, I think in other geographies, we'll invest ahead of the curve, or perhaps at an accelerated rate, but we'll continue to invest in Botswana. I think that Botswana has been good to us. It's been well managed. And, you know, I think that if you look at it from a resource point of view, you know, it has enormous mineral resources. And if we look at the mining licenses being issued, we look at what's happened to the tourism, we look what's happened to the agricultural sector. There's been lots of initiatives to increase manufacturing. So I think that there's certainly an agenda within Botswana to make sure that it has an economy that is not only reliant on diamonds. So, you know, I think we're aware of it, we're sensitive to it, but, you know, of all the things that keep me awake at night, that ain't number one.
I've got a good one in my DMs here. Given you don't participate in, you know, margin, as you say, it's a kind of a fee for service model. And the question is around then, why is there such a big need for working capital? So I think maybe just it might be worth reiterating, Duncan, you know, the differences between markets in how you service them, drives a need for working capital in some markets and not in others?
Yeah. So, outside of South Africa, we provide a full service offering. So, we need to, we take title of the stock. So we own the stock. And as we're expanding and the ambition is to grow at north of 20%, the working capital increases, and the working capital is around stock primarily, but it's also around people, so we need that to expand. I don't know if Frans wants to comment on anything else in particular.
Duncan, Mark, I think it's part of the service offering that we give to the clients, and in this building the margins to carry the working capital for our clients.
Okay, perfect. Thanks, Frans.
I've got an interesting one which just asks, when the retailers have merchandisers in their stores, so say ShopRite, for example, I mean, they would presumably have a relationship with suppliers to sell some of the data and intel. Does that mean you're effectively at times competing with the grocery stores, or is that just something quite different?
Yeah, I think that, by and large, I would describe us as a guest in the retail store. And because we are looking after their shopper and consumer and ensuring on-shelf availability, I guess we generally welcome, because, we're improving the shopper experience. But, in South Africa, we don't invoice the retailer because we don't deliver the stock, and therefore we don't own the data. The data that we get is via the brand owner, that the brand owner buys from the retailer as part of their trading terms. So, the data we get in store in South Africa would be, if I spoke about our mobile technology platform, it's data that we're doing and sourcing. But outside of South Africa, we physically invoicing the retailer, we physically delivering, and so we get access to a different set of data. So, I think that we're very careful not to compete with clients or customers, and therefore, we don't want to own brands, we represent brands, and at the same time, we don't want to make a margin on stock because we don't want to compete with the retailer. So I hope that answers the question.
Just another question in my DMs, just around bad debts in the business. How has that historically been? Has it been a problem? And, where does kind of the risk lie within the business model of, for, retailers who don't pay, who ultimately, I guess, bears the brunt of that?
I'm touching on what I hope is 100-year-old piece of wood. But we've been very fortunate with around bad debts, and you referred to COVID earlier, Mark. So even in COVID, our bad debts barely exceeded R1 million, and that was in the liquor space, where we supplied the independents, mom and pop shops, where because of tourism, they took a beating. But generally speaking, bad debts is not an issue in our business, bearing in mind that to some degree we have a lot of leverage. We're supplying tier 1 brands, and if somebody doesn't have the tier 1 brands and we're not delivering because they're not paying us, it's going to affect the business considerably. So no, I'm not worried about bad debts.
Okay, perfect.
I've just got a question around growth and some of the targeted, revenue that you're looking to hit in the next couple of years. Just around the size of the acquisitions you're looking at. I mean, you made some comments earlier about how you're looking for owner-run stuff. You're often taking minority stakes. Do you think you're going to get there by doing lots of smaller acquisitions, or do you think there might be some big ones in the pipeline that are really going to move the dial? Obviously, a difficult question to answer with any specifics right now, but I think it's important for people to understand, is it lots of small deals, or is it going to be some big bands?
Whether you do small ones or big ones, they take the same amount of time. And, the truth is we look at many potential transactions, and, we say yes to very few. So, I think over time we've developed a framework that enables us to say no very, very quickly. And so, I think that we look for a very specific type of business. You know, in that space, we're looking for businesses that can move the needle. So in other words, there is a threshold, particularly in the warehousing and distribution space, where if it's below a certain threshold, we won't pursue it. You know, I think that to answer the question specifically in East Africa, you know, I think in the context of previous acquisitions, you know, if we execute what we plan to do, it will be fairly significant.
One more one from me, Duncan. In terms of the expansion, you know, you had the map there of existing geographies and the East Africa expansion, but I noticed Mozambique was left out of that. Is that purely because the opportunity set is better in East Africa, or are you excluding Mozambique for, you know, rule of law, you know, government issues, you know, the transport infrastructure? Maybe just touch on, you know, given it borders so many existing geographies you already have, why that isn't kind of in the kind of geographic expansion mix at the minute.
Yeah, you know, I think that I don't want to comment on Mozambique specifically, but we have identified priority markets, and a large part of that is the opportunity and the risk. So, you know, I think that we have a very limited framework for risk, and we just think that we'll be better serviced in the markets I've spoken about. You know, I also think that if one looks around West Africa, becomes more complex, potentially around, you know, law, rule of law, understanding what's happening in modern trade, language, etc., etc. So, you know, I hope that answers the question, sir. Yeah.
Yeah, I think to try and get another one in time. So there's just a question around the current asset levels in the group, and just trying to understand where that comes from. So the question was basically, you know, if you're not making a margin on selling the products, what's driving the sort of current assets on your balance sheet? You know, what are those stocks that are being carried? How does that actually work?
Yeah. Frans, do you want to come in here?
Thanks. Yeah, as I said earlier, it's part of the service offering that we give to the clients. So to carry the stock, collect the debtors book for the clients, and then also pay the clients on as a supplier. So that's part of the service offering that we give our brand owners, and earn a service margin on that.
Yeah, look, I think, you know, if I understand the question correctly, you know, is that from a return on equity point of view, you know, we have a particular threshold and we want that to be north of 15%. And if I look at the half year, it was, I don't know, 16.8% or something like that. You know, we certainly don't want to compromise that. But when we supply retail and when we take on a brand owner in a particular geography, we're trying to reduce complexity for the brand owner. So in other words, when we're supplying, when we're doing business with them in Botswana, for example, you know, they got fairly high degree of peace of mind that by supplying us, we give them a check, but we deal with the complexity, and the complexity is to deliver to the, you know, thousands of outlets to make sure that we get the on-shelf availability, that we collect the money. And the more efficient I am in that space, I am able to get my margin. If I'm inefficient in that space, it's for my account. So in other words, if I'm making a 10% margin and I'm inefficient, I'm either going to get 9, 8, or 7. You know, the brand owner is not at risk. But also, you know, I think that it creates for us over time a competitive advantage and a moat that we're providing a credible service to the brand owner, as well as these customers and consumers are getting what the brand owner and the retailer thinks is a comprehensive service.
Duncan, thanks so much. I think we are out of time for questions. So thank you to everyone who chose to spend time with us today in this session. And a special thank you to you, Duncan, and to Frans and Dot for the arrangements and for making time to support this investor platform and to engage with the investors again. Just left to tell everyone that's on the call, our next session will be on Thursday, the 19th of September, and that will be with Lusaka Technologies. Thank you, everyone, for joining us again, and goodbye.
Thank you very much. Appreciate your time.